So today we'll be talking about the Fed's next move. Here's the executive summary. So we're going to talk about the May CPI report. It's 4.99%, so I just rounded up to 5. FOMC meeting next Wednesday, so maybe a potential pullback on QE, with one of the programs being like MBS, based on real estate being kind of pricey, and maybe something to do with the overnight RRP. Real rates and US dollar. Real rates might be moving higher along with the US dollar. CRB index making a 6-year high. We got to see if this is going to be a false breakup, and then further consolidation lower. And commodities update for precious metals, oil, and uranium. So these are the topics we'll be going over today. Again, none of these are investment advice. Please do your own research. I am not a professional investment advisor. So first up, let's take a look at the US May CPI report. So the headline again is at 4.99% comparing to and this is a year-over-year increase comparing to the April 4.16. So core, which is about in April weighting, is about 79.1% of the headline CPI. We can see that in May's core CPI, we're looking at 3.8, while the April's was just slightly lower than 3. Now, what caused the increase? So the weightings, these are all based on April's report. And then you can see the second column here. These are the May increase year over year. And then I did the weighted impact. So you can see the largest impact is coming from energy, and that's mainly due to the rebound in oil prices, based on the demand coming back, expectedly come back sooner, also more reopening, and OPEC plus being committed to their gradual increase of supply, but the Iran deal being struck, that's also a key part in terms of supply, so that is continued to be observed. Used cars, the year-over-year increase is impressive, but by the rate that they're increasing, the question is like, can they continue to do so going forward? And by this rate, like, used car is going to be more expensive than new cars soon. But why did used cars go up quite significantly? This is due to the chip shortage, which I think now is in a better position. But why does microchip matters? Because all these new cars come out have microchips in them, and that's one of the main parts that's holding up new cars. And because new cars are slowing down in terms of production, and that's why used cars are being bid up. Owner's equivalent rent. So this is kind of the Fed's way of calculating housing costs, which they take housing prices and also like rent into consideration, and they call it owner's equivalent rent. So even though a slight increase, but the weighting is quite large, which for most people, real estate is a big part of their consumption. And the question is, if this continues to increase, like we already see like impressive real estate prices increase, and it's not helping the average people, and that's going to put pressure on the Fed to do something on the housing side, the real estate side, which is why I think one of their first tools to pull back would be MBS, which we'll see again next week. Transportation services and airline fares. So as more people are moving around from the reopening that is coming back. So these are a few things, key points. So what is the Fed situation? There's more people talking about inflation now because they can see it in their prices, especially with oil. And CPI is finally reflecting higher prices. So we have the inflation expectation from more people talking about it, and we have the actual CPI reflecting it now because inflation from money printing it acts as a lag. And overnight RRP, this is where big institutes like municipal, state banks, and other like Fed credited investors can put their money or in treasuries with the Fed at the overnight rate. And the reason, and it's hitting like the highest level ever at 534 billion as of yesterday. And the reason why I think a lot of the big banks are depositing money, like there's just too much liquidity sloshing around. And what happens is when money is being printed and then the federal government sends out stimulus checks, and then that throughout the financial system being multiplied, what happens is it's generating a lot of currency through the multiplier effect, and the banks aren't willing to lend out more. Either it's just way too much, so they're just depositing it with the Fed, or they're unwilling to lend out. They're unwilling to lower their lending rates anymore because there's a risk when you lend out money. So they rather get 0% or 0.001% on a very big balance, so that's still some return, rather than lending it out at whatever rate they can charge, because they're not able to compensate that for the risk that they're taking on, because it's a high chance that person will go default and they can't repay the amount. So it's safer to make 0.001% than to potentially lose like 20% on the loan. And what this is going to force the Fed to do is potentially let a lot of its assets just mature instead of so they will potentially shrink their balance sheet. So they've done a few stress tests to the market with higher CPI that we saw with May. Market looks like it's taking it quite well so far, like no big corrections. And they've also been selling their corporate bond ETF. That does, again, one of those programs that was announced after the COVID pandemic began. And so next test will be the next FOMC meeting, seeing if they will further pull away from some programs. Again, I don't expect any rate hikes until later. I think they'll keep that on. But in terms of the pace of QE and what kind of programs, I think they'll start pulling those back. Now let's talk about real rates development and the US dollar. So for real rates, we can look at TIPS, obviously with various durations. So these are again the Treasury inflation protected securities, where they're US government issue securities, but the difference is the coupon and the final principal repayment. It gets adjusted based on inflation, and I think they do take the CPI as their benchmark. So looking at the 10 years TIPS for long-term assessment, the latest is at negative 0.91% versus the lowest, which is last year, July, I believe, negative 1.03%. So the real question is, will the Fed allow real rates to go further negative, or would they want to make it rebound? And the reason why you don't want for long-term wise a negative real rate is because it has a negative impact on the currency, which US needs strong dollar in order to keep the game going, meaning continue to export inflation, rack up massive debts, because if your currency is weakening, then inflation can really peak up. And it doesn't make sense for foreigners to continue buying US assets, which again doesn't help the US dollar. So now let's talk about the CRB index. I think I talked about this before, but if not, apologies. So it's a commodities index, and it's just hit a new high in 6 years. And so there are so as a component, we've seen a lot of commodities pull back already, with agriculture goods that I mentioned before, that like base metals with copper leading it, and there's also like lumbers also pull back. So the only lagging group that hasn't made like a further run, like impressive run comparing to the other ones, are really energy and precious metals. So one third being energy, so oil will be a big key um, in terms of whether CRB will have a false breakout, maybe potentially running back down into continuous consolidation before eventually breaking up higher. So oil will be key to watch for the whole commodities um, matrix. Maybe it'll lead other commodities higher, so we'll have to see. Finally, let's talk about commodities update. So precious metals for gold already seen a nice run from bottom of 1680, the nice, um, double bottom, the W shape, and now hitting resistance. Now the Fed's next move and future real rates development will determine if there is future upside. So right now, and potentially a new high, so that is continued to be observed. If Fed is really going to just pull the plug, like start tapering, start quantitative tightening, start shrinking the balance sheet, again, if that happens, then it's quite possible that the precious metals run is over. Silver, because it has the industrial aspect to it, fundamentals are still strong in terms of their supply and demand. But again, if the inflation trade is over, then silver could take a hit lower before coming back in the future due to supply and demand with the push of more renewables. So it's still sorting out the last false breakout around $30 from the last, Wall Street bets silver short attempt. And so until it breaks $30, it's still wonky. So it's still a watch. We'll see where it can go. But if it breaks that $30 resistance, then we might see a quick run to 40. Oil. So Iran deal has been signed, so that's dealt with. OPEC plus members are still committed to their agreements, and they have been increasing the future forecast in terms of demand, with more people taking the vaccines, more areas are able to reopen. So I'm still expecting it to hit $80 this year and maybe 100, but it really depends on the continued development on both US dollar, real rates, and obviously again political concerns. And finally, uranium. So fundamentals remain strong, especially with more companies coming out and saying they're withholding their uranium, and they're also buying up supply like themselves as producers. And that's why the equities, the space, have seen quite interest recently. We'll have to continue to see until, and it's again very hard market to watch, because once the spot market, like I think it's below 20% of the whole market, because a lot of it is behind the scenes with the utility companies and the producers. And so once we see the spot market really moves, then I think by then it's kind of on the later end of the train. But I do expect it to at least go up to $40-50, because that's the kind of break-even point for the producers, including impairment write-offs and such. So that's the kind of the break-even point. And because uranium is a necessity in terms of energy production, then the prices should reflect the break-even point for the suppliers.